What's up, everybody? What's up, everybody? It's your boy Chris. It's your boy Chris. It's another amazing episode of Financipation. This channel is all about making money, saving money, building generational wealth, and financially emancipating yourself from generational poverty. On this channel, everybody, I give you a six-figure MBA level worth of investing in financial knowledge for free here on YouTube. And the things that people typically spend hundreds of thousands of dollars learning in grad school, I give it to you for free here on Financipation. And as a person who has an MBA, I take serious pride in saying that, okay? Also, before I get started, I want to give a shout out to one of my sponsors, Kilica Solutions. If you need digital marketing, website development, or something to essentially edit your YouTube videos, they're the best in the business of meeting all of your digital needs. Additionally, please hit the notification bell, okay? So that way you know when I drop new content. So with it being tax season, everybody, today I want to drop a podcast on 4 investments that can massively and legally reduce your taxes. So let's get started. The first investment that can massively reduce your taxes is your 401k. The 401k is aptly named after the 401k section in the Internal Revenue Code, and because it's managed by your employer, they select the broker and the investment options that you can pick. So there are 2 types of 401ks that are available to you, the traditional 401k and the Roth 401k. For this particular podcast, we're going to focus exclusively on the traditional 401k. If you follow my channel, you are well aware of the fact that I am a huge proponent of the 401k as the first investment strategy that I tell essentially all of my clients to do. Why? Because you should always invest into your employer's 401k match if they offer it. Why? Because it is literally free money. So if I walked up to you on Valentine's Day and I said, give me $10,000 and I will give you $20,000 on Christmas Day, name one of you that would not take that deal. And the reason why you would take that deal is because it is literally free money. Yet sadly, a 2023 study shows that close to 40% of Americans do not contribute up to their employer's 401k match. And people, this is very dumb, as this means literally 40% of Americans are turning down free money. The second reason I love the 401k is because it essentially lowers your taxable income by several thousands of dollars every year if you choose to use it. At the time of this recording in 2024, you can contribute approximately $23,000 to your 401k. So in essence, this is what that means, okay? If you make $50,000 a year, people, and you contribute, let's say $10,000 to your traditional 401k, the federal government, the IRS, is only going to tax you on $40,000 because you are making your contributions on a pre-tax basis. It should also be noted that the 401k offers some protection from federal tax liens because the 401k legally belongs to your employer. It therefore makes it slightly more difficult for the IRS to place a lien on your accounts. So everybody, if you are serious about massively and legally lowering your taxes, invest as much as possible into your 401k and max that thing out every year. Next, the next investment that can massively and legally reduce your taxes is the traditional IRA. So similar to the 401k, there is a Roth IRA and a traditional IRA. And for this particular podcast, we're going to focus on the traditional IRA. The traditional individual retirement account, or IRA, offers a slew of benefits to investors that are serious about financially emancipating themselves from poverty and building generational wealth. The thing that I personally love about the IRA is that you are allowed to pick the investments that you want. So unlike a traditional 401k that is essentially owned by your current employer, and your employer for a traditional 401k picks the stocks and picks the funds that you can invest with. But with the traditional IRA, you can pick the ETFs, the specific index funds, the mutual funds, the REITs, the individual stocks, and any of the types of stocks that you want to essentially pick that you research on your own. So if you want to buy individual shares of, say, Apple, or Facebook, or Microsoft, or precious metals, or gold, it's very easy to do that with the traditional IRA. My wife and I's personal investment strategy, full disclosure, is that we invest quite a lot of our money into passively managed low-cost index funds that I purchased through Fidelity and through Charles Schwab. And at the time of this recording in 2024, you can contribute approximately $7,000 into your IRA. And with the traditional IRA, it lowers your taxable income. So imagine you make, for example, $50,000 a year and you contribute approximately $7,000 to your traditional IRA. Because this is a tax deferred account, the IRS will only tax you on $43,000 for that calendar year. So everybody, if you are serious about massively and legally lowering your taxes, invest as much as possible into your traditional IRA and max that thing out every year. Please hit that notification bell so that you know when I drop new content. Please hit that like button. Please share the video. Please comment. Please share. Please subscribe. It helps the algorithm, and I thoroughly enjoy giving you all free content. Next, the next investment that can massively and legally reduce your taxes is your HSA account. If you follow my channel, you are well aware of how much I love the health savings account, or otherwise known as the HSA account. In my opinion, HSAs might arguably be the strongest and the best investment vehicle, period, on the market because it's a triple threat. HSAs are essentially a personal savings account that can only be used for medical expenses. HSAs, everybody, has significant tax advantages that allow you to use them as a retirement plan alongside your 401k and your traditional IRA accounts. So, firstly, HSA contributions are pre-tax dollars, which means they essentially lower your taxable income as you don't pay taxes on any money that you directly put into your HSA. So if you make $50,000 a year and you put $4,000 into your HSA, the IRS is only going to have you pay taxes that calendar year on $46,000 because it's a pre-tax account. Secondly, and it lowers your taxable income. Secondly, as long as you use the money in the HSA for qualified medical procedures, the IRS and the state won't tax you on your HSA withdrawals. And third, HSAs grow tax-free, and the interest and other earnings that grow into the account also grow tax-free. Lastly, the money invested into HSAs don't expire, and in theory, they can stay in your account forever. So this means that similar to a 401k or the traditional IRA, the money that you put inside of an HSA literally just rolls and rolls and rolls and compounds and compounds and compounds day in and day out, year in and year out, decade and decade out. And as a result, it gets bigger and it utilizes the tremendous power of compounding interest. Another thing that I love about HSAs as well is that you can typically purchase any type of index fund, any type of ETF, any type of mutual fund, or any type of REIT that you want inside of it. HSAs, everybody, they can be used for therapy sessions, dental and mental and health procedures, pregnancies, and a wide range of qualified medical expenses. HSAs, everybody, in my opinion, are truly special because they combine the best elements of the Roth IRA and the traditional IRA accounts all into one very special package with very little to none of the drawbacks. At the time of this recording, everybody, in 2024, a single person can contribute approximately $4,150 into their HSA account, and a married person can contribute approximately $8,300 into their HSA account. My wife and I, as I stated earlier, we invest with passively managed low-cost index funds and ETFs for most of our investments, and we have maxed up the HSA literally for as long as I possibly could once I found out how powerful this investment tool was. Lastly, everyone, I want to reiterate that I am talking about HSAs or health savings accounts, and I am not talking about FSAs, which are flexible spending accounts. I'm a huge proponent of HSAs, but I avoid FSA accounts like the plague. Why? Because they are completely different from an HSA. And unlike an HSA, FSAs don't give you nearly the amount of tax benefits, and they're not nearly the type of taxable efficient income that HSAs are. So if you are serious about massively and legally lowering your taxes, invest literally as much as humanly possible every year into your HSA account and max it out every year. The next investment we're going to talk about that can massively and legally reduce your taxes is real estate. So firstly, with homes, you have mortgage interest. So each month, a part of your mortgage payment goes directly toward the principal. The principal is the amount that you borrowed on the home. Over the entire life of your home, you can deduct interest paid up to $750,000. And if you bought a home between 1987 and 2017, you can deduct interest paid up to $1 million. Next way that homes can lower your taxes, you can deduct a home equity loan interest. A home equity is essentially a second mortgage where you borrow against the equity you have in the home. So if your home is worth, let's say, $500,000 and you still owe $300,000 on it, you have $200,000 in equity built into your home. And as with your first mortgage, the interest you pay on your home equity loan could be tax deductible. There are no restrictions on how you can use this cash from a home equity loan, but the interest is only tax deductible if you use the money to make substantial home improvements. Third, you can deduct discount points. You can pay a fee referred to as discount points in closing that lowers the interest rate you'll be paying on your mortgage for your home. One discount point usually costs about 1% of your mortgage, and it reduces your rate by 0.25%. So, for example, say you have a rate of $800,000 mortgage is 3.5%, and you pay $16,000 for 2 discount points. Your new interest rate for your $800,000 home would only be 3%. The money you pay for discount points is typically tax deductible over the life of that loan. The next way that homes can lower your taxes, property taxes. You can deduct up to $10,000 per year in paid property taxes if you are single. You can deduct up to $5,000 each year if you are married or you're filing separately. And you can deduct up to $10,000 if you are married and filing jointly. And this limit applies to both local and state income taxes combined. The next way that homes can lower your taxes, home improvements. Necessary improvements to your home may be tax deductible, everybody. For example, if you need to make improvements to update the home for, let's say, medical reasons, or to make the home accessible to someone with disabilities, those expenses may be tax deductible. The next way that homes can lower your taxes, home office costs. So you may deduct home office costs if you run a business out of your home or use a specific room or space exclusively to run your business, your legal business. This, however, does not include work that you do from home for your current employer if you are a W-2 employee. For example, if you live in a 4,000 square foot home and your office is only 1,000 square feet, that means you can legally deduct 25% of your mortgage for tax purposes because 25% of your home is legally being used to run a business as an EIN number. So everyone, homes are a tremendous way to legally and massively reduce your taxable income. In closing, everybody, this channel, Financipation, is all about making money. It's all about saving money. It's all about building generational wealth. And it's all about financially emancipating yourself from generational poverty. You can book a one-on-one session with me at any point. The link is going to be below. I'm not giving you financial advice on this channel. You must make responsible decisions based on the thorough, independent research that you do for yourself, okay? And thanks for listening, everybody. Please follow me. Check me out on my website at www.therealfinancipation.com. Please check me out on Instagram, @thereal_financipation. Please check me out on Spotify, Financipation. My TikTok is also Financipation. And my Facebook page is Financipation. Check out my financial blog, Financipation, where I go into a lot more detail about HSAs, the Rockefeller Trust, ETFs, and all the kind of things. And also check out some of my digital e-products below as well. Hit the notification bell as well. Please like, please comment, please share, please subscribe. It helps the algorithm. And thank you, Killer Solutions, for all these dope graphics. It's your boy, Chris. I'm out. Peace.